some people don't understand their company enough to know how to present it. We know a lot of companies who are growing often present themselves in an equity light and go to a lender that way. And a lender doesn't want to view you the same way as an equity owner and an equity investor is going to view you very differently than a bank. And I think understanding who you're targeting when you go to them is very important. And when you go to a bank, talk about things like cash flow, which we talked about a lot here today. Talk about collateral. Talk about those type of things. The banks are less interested in what's your return going to be, how fast you're going to grow. In fact, the banks don't like super fast growth. They want slow, steady growth that they can measure that's really going to be achievable. And I think understanding who you are, what your goals are, and then presenting that to the lender and to the right lenders is very important to getting the best capital structure you can. And I think understanding, do you need debt? Do you need mezz? Do you need that bridge capital? What do you really need to grow? And then understanding, what do we need today, but what do we need in the future? And I think we see oftentimes companies that are bootstrapping themselves thinking, okay, what's the cheapest alternative versus what's the best alternative? And sometimes that you need to weigh both of those. I mean, you want to get a cost-effective solution, but you want to make sure it's meeting your needs. And that's, I think, critical to a lot of companies. We see a lot of companies who weren't doing that. And it came back to bite them when they entered the market and then they couldn't grow and they couldn't do the things that they need to do because they didn't have the right capital structure or the right partner.
So I think it's pretty obvious that debt is the cheapest form of capital. Obviously when companies are looking to raise funds, the founders are very sensitive to the fact that they don't want valuations which are going to dilute their ownership much larger than the previous round. And when it comes to different types of debt, working capital lines of credit, there usually is not any piece of a warrant which a bank will take. Personally, we don't take warrants when we have financial covenants around deals, things like that. So when you get into working with venture debt providers, they will take a much larger warrant position, which again affects the cost of capital when you're looking at debt versus equity. But I think the main thing here is whether it's around preferred stock, common stock. I'm not certain about which one's more expensive, which one isn't. But I think when boards and management teams are looking to either raise additional capital or go out and raise venture debt or some other form of debt, the management teams are very, very sensitive to the fact that they're sometimes willing to pay a little bit more for a debt solution as opposed to giving up the ownership that a lot of these guys are the founders that they've worked year after year trying to build the value of their company, so they're less willing to give up that ownership.